Hey team, Jake here, and today we are with Matthew Lewison, who's a great friend of mine. Welcome to Louis, and he is the CEO and founder of a company called Corp, and he's going to be talking to us today about building wealth and building a better future for yourself and your family financially. And Louis, thanks very much.
Yes, thanks for having me.
And I'm going to be awkwardly holding this microphone in between us today because we're in a coffee shop and we don't want to be too noisy for you guys.
Very professional studio.
Yeah, absolutely. So anyway, welcome. Thanks to Louis. We've got 15 minutes, so we're going to be super quick and get to the point. But before we do, Louis, can you tell everyone why they should listen to you on this topic?
Yeah, look, I'm probably very fortunate in that I had a first-hand experience and education in growing wealth through my father. And when I was younger, my parents weren't overly wealthy. My dad worked as a sales rep, and he had a second job doing estimating for a concreting company. And through that, he was already passionate about property, but he met a couple of Italian concreters who were mad about property, and they just filled his head with all these ideas, and his passion grew. And in the mid-1980s, he bought his first investment property, actually built some townhouses, and sold 3 of the 4 townhouses, kept 1. So my brother and I were lucky enough to watch him as we grew as well. We were spending all our time in the holidays on his development sites and his investment properties, helping to clean them up between tenants or clean up sites that were under construction. And we're just immersed in it. We saw him transform his life financially from 1984 through to the mid-90s. And as a result, we saw firsthand the highs and lows of the property market, but also, I guess, understanding how he followed a really simple system and process. He just dealt with the affordable end of the market. All of his properties were always rented out. But that made my brother Alistair and I really passionate about investment. I went to university and studied corporate finance. I went to work for a large public listed developer. Was really fortunate to rise through the ranks there quite quickly, and then founded Corp with my brother Alistair and our other business partner Cam McClellan, who's author of a book on investing. In the late 2000s, we founded the company, and Corp's a diversified investment house, I suppose, where we offer property investment advisory services, finance broking, property management, funds management, and a few other bits and pieces. So it's kind of all that we do now is invest and advise people on how to invest themselves. And as I said, I was really fortunate to have the upbringing I had in that regard. And while I didn't go to any prestigious school, I think the schooling that I got from my dad was as valuable, if not more valuable, than anything I could have got at university and obviously at high school as well. So hopefully that qualifies me.
Yeah, that definitely qualifies you. And just from that, lessons just from your little story there. One, hang around people. If you want to make more money, hang around people who know how to do it.
Absolutely.
You learned that from your dad.
From your dad, and dad also learned, like, he was
from someone
around
else.
Other people who were.
He didn't just magically wake up with that knowledge one day.
Absolutely.
Have a plan. You mentioned your dad stuck to certain buildings, right? Certain properties, certain types of properties. That's very cool. And the third lesson that I took away was you don't necessarily need to have a super high income to build wealth.
No, well, what I didn't mention, so I bought my first property when I was 18. So obviously having this dad.
You're 21 now. 22.
So when I was in my teens, my brother and I he's 3 years older than me, we were already reading books, Rich Dad, Poor Dad, a bunch of other sort of Australian and overseas books on how to grow wealth. And we went to seminars, so we just immersed ourselves in that, absorbed as much information as we could. We saved up all of the money we were earning on sites with dad and working part-time jobs. So when I was 18, my brother was 21, and neither of us had enough money to buy a property, but together we could afford a deposit. We paid $120,000 for a 2-bedroom unit in the outer suburbs of Melbourne, putting 20 grand down ourselves, and that got us into the market. A few years later, or the next year, my brother was able to afford to buy his own property as well, and he just started to build on his portfolio. I was at uni, so I wasn't earning quite the same money he was, but every couple of years I just kept adding to that, and following the same pathway. But we certainly didn't earn a lot of money when we bought our first property. And I think that's one area where even a lot of our clients today come through and they all think they have to do it themselves. But there's so many other sources to at least get into the market, or even if it's not property, if that's not your thing, to get into investments. You don't need to start huge and you don't need to risk everything all on your own. You can pool with other people. You can go small into certain things. There's funds now popping up that allow people to get into the property market with as little as $1,000.
And you're going to be releasing one of those soon, right?
That wasn't a segue for that.
No, but you are.
But certainly, I mean, that's one of the things that that we feel that there's a lot of, when you look at through 1994, 70% of people own their own home. Today, that 62% of people in Australia own their own home. In just 24 years, it's dropped. It's expected to continue dropping, just because obviously affordability is sort of continuing to get a little bit out of reach for people trying to do it on their own. And we wanted to make something that allowed people to get into the market and help them to save for a deposit. And if the market is going up and there's a bit of heat in the market at a time, you can't save as fast as the market can go up or as fast as the investment can go up if it's rising. So it allows them to get into the market earlier and then take their money out when they're ready to buy their own property and obviously not fall behind the market. So, but there's others out there as well. There's some interesting funds popping up, but obviously a lot of people focused on this part of the market, trying to help people to get in and follow what's happened overseas, where it's a huge thing.
On that kind of topic, I think a lot of people, when they think of investing, they think of buy my own home, and that's about it, right?
Absolutely.
So, and we're short on time, so we're trying to get as much crammed in the next 10 minutes as we can. But what are the different options for people as you see them? So average Joe out there on a typical, fairly average income with a little bit extra, left over at the end of the week?
Well, Scott Pape has a great book, The Barefoot Investor, and I know it's not for everybody. There's a few really simple things I love about Scott Pape's book. His ways of managing money, and a lot of people have trouble following a budget. Even I have trouble following a budget. I can always
buy too many pink shirts.
When I have surplus cash, I'm happy to put it into investments, and I'll invest first. So I've never actually thought of myself as a saver, because I'll invest my money and then what I've got left over, I pretty much spend everything.
And the concept of saving for saving's sake, like there's two schools of thought. One, you need to have a buffer, but two is inflation's going to outweigh your savings, right?
Yeah, so I guess that's the purpose of investing. And savings, if you're just saving, you're putting money under your mattress every day, you're going backwards, because inflation obviously means that the value of your $10,000 in a wad under your bed won't buy you what $10,000 will today if you're leaving it there for 10 years. So investing, even if your money's in the bank, that's an investment. It's in a savings account. You might be earning 1% interest. It's still an investment. That in itself won't keep up with inflation. So the idea is to at least get ahead of inflation, but also to grow above that. It's a great book, really old book, The Richest Man in Babylon. And in that book, it talks about saving 10% of what you earn, investing it where you can earn 10% on your investments, and reinvesting what you receive as dividends from that investment. And it's a really simple model, and maybe 10% home returns aren't easy to come by for everybody on the street. But to reinvest what you earn and to keep a regular savings plan going into investments where you're earning more than what you get in the bank is really sound advice as well. And if you look outside of property, there's I think the other thing that Scott Pape recommends is looking at index funds. If you don't have time, you're not interested in the share market, essentially an index fund is a fund that buys the 200 or 500 biggest companies in the country that are on the stock exchange. So, for instance, Facebook didn't exist 20 years ago, so it wasn't in the top 500 companies. But then all of a sudden, they entered the market. They grew really quickly. They entered the top 500. One dropped out for them to enter, and obviously they've taken the market up, as have others. So it's always constantly investing in the best companies.
And that just makes it a lot more consistent instead of investing in one company and riding the ups and downs.
You don't have to pick. And it doesn't necessarily mean you're going to become rich overnight. It's a long, steady plan. But if people are minded to going into property, because property is obviously over the long term proven to be the most stable, lowest volatility investment that generates the highest returns. But if the barriers of entry or just the mindset is to do something different.
And knowledge, right, in property, like you got to also know what you're buying and why you're buying it.
Yeah, I mean, businesses like ours exist because people can't know everything. And I suppose it's like me turning up and saying, all right, I'm a fitness expert. I saw somebody running down the street the other day, or I spoke to my mate at the barbecue on the weekend about exercising. So I'm just going to write my own program and go nuts. I'm not going to get the same outcome that somebody coming to a business where there's professionals who spend every minute of the day thinking about the best ways to get people fit, to avoid injury, and to get people healthy. So with property, people make that mistake. They spoke to their mate at the barbecue. They said, oh, I'm going to go and buy a property. Round the corner here, there's really good buys over there. You should look at that.
Buy in the mining town.
Yeah, buy in the mining town. Or talk to your local real estate agent. Of course, the local real estate agent is going to tell you they've got the best investment property, because they don't get a commission off you if you buy interstate or you buy on the other side of town. So you got to be really careful about where you're going for that advice, and not just relying on yourself and a bunch of non-experts if you want to get into property. So read as much as you can. Talk to people who are experts. Talk to people who have done it, not just who say they've done it, but people who have genuinely done it and can demonstrate that, because you're going to get a much better outcome following a proven path than
and when it comes to choosing an investment, obviously there's three main classes of investment, right? You've got property, you've got shares, and you've got businesses. And then there's kind of all these subdivisions of all of those things. Some are riskier than others. Like, what should someone look for when trying to decide what's the best way for them to invest?
All right. So it comes down to risk profile. And if I use my dad as an example, so my dad's strategy was to invest in the affordable end of the property market, because he saw there was always more people coming into, or the population was growing, that there's more people coming in at the bottom end of the market than there is at the top. And if he's providing product or housing for the bottom end of the market, they'll always be able to rent them out, and they'll always be able to sell them. So it was a risk management strategy as much as a wealth strategy. Now, there's people who can make a fortune doing premium products, for instance, in property, but they have to know that market inside out, and there's a huge risk if they don't get it right. So it's sort of understanding what's your risk profile, how do you manage those risks, and how do you get a reasonable return for the risk that you're taking on and the money you're investing in. Again, most people think they have to get rich in the next 5 to 10 years, but generally if you approach it as a 20, 25-year game plan, with the ultimate outcome being you don't just want a lot of assets hidden somewhere from you that you can't touch, but you can say, I'm really rich because on paper I'm worth $2 million. The goal of all investment is to generate an income and start to slowly replace your income, which will give you more flexibility in your lifestyle and give you more choices and give you a backup plan if something unfortunate happens to you as well. So, think about where do you want to get to? Same as with an exercise, but what do you want to achieve? What's the risk that you're prepared to take on? What are you going to be comfortable with? Do you want to be able to sleep at night, or are you happy to live on the edge of your seat a little bit? And then what's the best way to get from A to B, knowing your risk profile and appetite and how much you can invest? That's kind of the simplest way to describe it.
Okay. Very cool. And we got 1 minute left. So in 1 minute, what haven't we covered that you think people should know? What would be the one thing you could leave people with?
All right.
I know I put you on the spot.
All right. So I'm sure this is something that you talk about with your team and your clients as well, but a lot of people think that life and finance is an area of scarcity, and it's not an area of scarcity. So as our population grows, this is just the simplest way I can describe it. As our population grows, the amount of money in Australia goes up. For our wages to keep going up on average, it means that the government's printing money and it's more and more money coming into the economy all the time. So it's not stagnant. So the goal is to ensure that you're setting up a system that allows you to capture capture more and more of that money that comes into the economy. And there's plenty for everyone. And you don't need somebody else to lose for you to grow your wealth.
It's not a zero-sum game. It's,
absolutely.
We can all win.
Everyone can win, yes. But if you think of it as a area of scarcity, then you're less likely to start, because you think it's out of your reach, or it's not possible for you to be wealthy or financially secure. So if you think of it as an area of abundance, there's plenty for everybody, but it's just a matter of working out ways for you to get a little bit at a time and keep growing your pool.
You don't have to win the lotto one day.
Absolutely.
Not a good strategy. And I guess, in terms of changing a belief is what you're just talking about. The number one way that we found that is changing your environment. In other words, getting around people that speak that language, reading the books, like you said. 1 or 2 books for people to read. You already mentioned.
So I've already mentioned Barefoot Investor, Richest Man in Babylon, which is an old one, a fable. It's really easy to read. My 4-year-old, The Property Investor, which is written by my business partner, Cam. But I think it's a really simple one for people to understand if you're thinking about property. I could reel off another 20 or 30, but...
start with those 3.
Start with those 3.
Louis, thank you very much.
Thanks, Jack.
And any questions, guys, pop them in the comments here, and I'll get back in touch with this guy and get some answers for you.
Happy investing.